And now I'd like to introduce today's moderator, ERM Program Director and President of Symergy Inc., Sim Siegel. Sim?
Thank you, Jay, and welcome to everyone joining here in the room. I see students, alum, faculty. We have folks joining us remote, and this will, of course, be recorded and posted up on our website for viewing. This is one of our most popular events where we do one-on-one interviews with prominent chief risk officers from around the world. So let me welcome Ed Fishwick, is the Chief Risk Officer, a member of the Global Executive Committee and head of the Risk and Quantitative Analysis Group of BlackRock. He is responsible for the investment and enterprise risk of BlackRock. He is also the chair of BlackRock's Enterprise Risk Management Committee. Prior to taking on his current responsibilities in 2022, Mr. Fishwick served as a global co-head of the Risk and Quantitative Analysis Group in London for 15 years. His service with the firm dates back to 2003, including his time, with Merrill Lynch Investment Management prior to its acquisition by BlackRock in 2006. At Merrill Lynch Investment Management, he was head of risk and quantitative analysis in EMEA. Welcome, Ed. So before we begin, I'd just like to ask if you could give a brief overview of BlackRock for the group.
Of course. So firstly, thank you for the invitation to be here. And so very happy to be here this morning. So BlackRock, as many of you will know, is an asset manager. We manage other people's money. We have a kind of very heterogeneous client base, from large corporations, sovereign wealth funds, governments, through to individual investors. We are global. We have offices around the world. We manage money around the world. We have clients around the world. And those clients are, heterogeneous in terms of their objectives. And what we're essentially trying to do is help clients achieve those objectives. And we do that through a mix of different types of money management, different types of strategies, taking different amounts of risk. A large part of what we do is about indexation, so tracking indices, and that's very much client-directed money, where clients say, I want to invest in US equities or emerging market bonds. So a kind of very large array of choices for clients. And then another very significant part of what we do is around active management, seeking to add value in a variety of different ways. If you've heard the term alpha, that is about generating alpha for clients. And so, that whole mix of things comes together as BlackRock, but our overarching objective is to manage people's money with the objective of helping them achieve their objectives.
Thank you for that overview. Before we begin, I just should please excuse my note-taking. Helps me focus my listening as you're answering the questions. So our students and alums and faculty are curious of how ERM works, and also to hear your guidance for their career in ERM and risk management. If we could start with, what was the impetus that initially launched your program?
Sure. So, BlackRock is a relatively young company. It started in the late 1980s. And really from its very inception, when it was tiny, risk management was a central part of the way BlackRock conceptualized itself. And it would describe itself not just as an investment manager, but as a risk manager too. And so risk management is very much in the firm's DNA. It's central to what we do. And in part, that's because, the firm has this idea that risk management is a central part of, any modern investment process. Now, I would differentiate between investment risk and enterprise risk that we manage on behalf of clients, and risk relating to BlackRock, the entity. And I know the focus here today is very much on that latter type of risk, BlackRock, the entity. And I would say that for many, many years, the overarching focus in BlackRock was on the first piece, on the investment piece. But as the firm grew, and as it grew organically and it grew by acquisition, it became more and more clear that the enterprise piece was also critical, and that we needed a highly developed enterprise risk management program. And I think the real kind of cliff edge for us, when we realized we had to kind of become very serious in that space, was in 2009, when we acquired Barclays Global Investors and became, at that point, the largest asset manager in the world. And it was clear to us, but it was also clear to regulators that, given that we were the largest asset manager in the world, we needed a highly developed, highly articulated enterprise risk management program. And so we'd always done this, obviously, but that was the real step change. In 2009, we put in place a development program to evolve what we did there. And looking back 14 years later, it's been quite a journey, but we are in a very, very different position today than we were back then. So that was the real impetus. So risk management has always been in our DNA, but a lot of that is about investment. The enterprise stuff has kind of grown, in a sense, with the evolution of the firm.
Thank you for that. So you mentioned a couple of things I noticed, which, and a lot of our graduates are going into consulting. The larger firms eventually maybe their own. So interested in drivers that people adopt. So you mentioned regulators focus on this. Rating agencies sometimes push people, and growth. So we see that a lot too, of course. When people grow to a certain level, like now we're a little bit more complex. We need to start managing this a little bit higher level. To get into a little more of the details, can you walk us through how you conduct your qualitative risk assessments?
Sure. So we have a structure that is, I'm sure, similar to many other firms, where essentially we identify a number of key risks. And so you could think about operational risks, you could think about investment risks and market risks. And within the operational risks, you would have a number of categories, like operational risk itself, maybe risk around technology and cyber, maybe risk around people, maybe risk around financial crime, and so on and so forth. And those risks are essentially identified qualitatively. It's a highly socialized process, and its creation was a highly socialized process in the sense that you're talking to senior leaders, you're talking to business owners, you're talking to committees, and so on and so forth. And you are evolving that kind of highly qualitative framework towards a description of the firm that people recognize, that doesn't seem artificial, and people think is complete. So there's not obvious things missing. You do the same in the kind of the market space, the investment space, where you're looking at things like volatility and liquidity and so on and so forth. And basically that comes together as a description of the enterprise risks of BlackRock. Each of those categories has a risk owner, so somebody who represents that risk at a senior level for the firm. And then beyond that, it's about beginning to calibrate things like the quantity of risk you're taking right now at an inherent and residual level. And it's also about bringing in things like risk tolerance. How much risk does BlackRock want to take in each of those dimensions? And so in some sense, it's totally made up. Like it's totally artificial. That structure doesn't exist in reality, and yet it is a useful reduction of this kind of enormous complicated firm into a set of dimensions that describe the risk it's taking, allow you to quantify that risk, which we can talk about some more, allow you to compare it to tolerance and understand whether, in terms of the risk you're taking, you're where you want to be. Because one of the kind of key insights in risk management, and I'm sure you all know this, is the objective is not to take, it's not to not take risk. You want to take risk because this is a business, you're trying to achieve things, and in order to do that, you have to take risks, but the risks have to be calibrated in such a way that they make sense, that you expect that the return on those risks is commensurate with them. and that crucially in aggregate they make sense. So it's easy to get kind of like confused by like individual things and kind of miss the whole. And so I think we drifted off the question slightly, but that's...
Well, there was a lot you provided. Let me just jump in with one aspect that I wanted to ask about. One thing I really like that you described, and we teach this, is you need to cast a wide net, not focus it narrowly in the organization. What I heard was you reaching out to a broad range of people to make sure you get broad perspectives and then get it vetted so that people agree that nothing's missing, that's significant. The calibration we get to when we get to the quantification. Can you talk a little bit about, you also mentioned talking to people. So I'm assuming these are interviews, not surveys. I don't know if it's one-on-one or group or a mix. Can you talk a little also about the frequency with which you refresh this?
Yeah, so this is very much discussion, not kind of surveys and forms and so on. The motivation is that you, as a risk management department, as enterprise risk management department, you can create a structure which you think is beautiful and you think describes the firm and you think is useful. But if you have not socialized that along the way, if you've not sought input, there's this kind of like obvious risk that like you have risk management here and then you have the firm here, but there's actually no interconnectedness. There's not really a kind of organic relationship between risk management and the enterprise itself. And so in terms of wanting to have risk management embedded at the heart of the firm, that socialization is a kind of necessary precondition. It has to happen. And then secondly, it's always been my belief that there's no reason at all why the risk management department has all the answers. There is absolutely no reason why the risk management department is best placed to understand all the risks, because this is an enormous, complicated, changing firm. And so we work with, business leaders, with senior people across the firm to understand what the risks are, to assess whether, our aggregated risk process is actually, doing what it's supposed to do, through time. A good example of that would be, we recently kind of changed some of our liquidity setup, some of our liquidity metrics to basically allow for the growth of private assets in our business. So like through time and historically, private assets were a relatively small part of what we did. And so when we looked at the liquidity risks to the group, they were all focused on the public assets. That's now changed, so we modified that in our risk dashboard. So it is, as I say, it's qualitative. It's not structured in the sense that there is, every 3 months I'll come and talk to you, or every 6 months. It's very much driven by the evolution in markets, the evolution in what we're doing.
This is continuing.
Yeah. So another kind of insight there is that one of the traps you can fall into is that you think in calendar time, and you think that I'll look at something every 3 months, or every 6 months, or every 12 months. But sometimes nothing's happened. And so it's not really worth looking at it again. Other times, three things have happened over the year or over the month, and it would have been better to do it. So we have this kind of idea that time doesn't move kind of at a set rate. It moves in an elastic way, and that impacts both investment risk, but also enterprise risk. And you are responding to changes in the environment and changes in the firm.
That sounds like a very healthy approach, because when I see people say, well, we do this every so on, well, what if markets just been more volatile lately? What if you just acquired a bunch of, so it doesn't necessarily make sense. It also tells me what I think is that it's a very practical program that you have. It works, because once you set it up, it should be continual. You should have a network of connections. People know if they want to raise their hand, identify something, there's a way to connect, to vet it, as you say, to calibrate it, get it integrated, see if it matters in the scheme of the enterprise risk, and manage at the risk management level, fine. Both need to happen, but it should be dynamic, and those network of connections should be operating all the time.
Yeah, so you need structure, you need process, but you can't become too mechanistic. because this is an organic situation, it's a fluid situation, markets change, economics change, things change. And so it needs to be, as you say, practical. It needs to be just like honest and realistic and not overly regimented, but it's a big complex thing. So you need structure and process.
Can we get a little bit into the quantifications? Once you've identified the risk and you're operating to quantify it to then lead later to decision making, how do you approach that?
So at a very high level, when I think about this, my starting point is, things are complicated. And very often quantification can be a kind of a spurious, a false, a kind of misleading kind of thing that suggests precision where there is no precision. Okay, so again, we have this basic mantra that models are useful and models are important, but they're just models. And, very often, there is a trap that kind of like false precision exists. So, I described a framework in which we have an array of risks, through operational risks, through investment type risks, through kind of business process type risks, and so on. And in each case, we do have quantitative metrics that kind of like come through and suggest some level of risk. So we would have like key performance indicators across each of the risk dimensions. So for instance, if it was, if it was like model risk, we might look at the number of model exceptions, the number of errors thrown up over set pieces of time. So for all of the risks, we would have like set KPIs, which we aggregate and come up with an indication of risk level. And that's kind of published on a continuous basis. And we look at it, management looks at it. It's shown to the board risk committee on a regular cycle. But there is a significant degree of qualitative override of what comes out of the modeling. And that override is basically driven by the risk owner. It tends to be increase, not decrease, of the estimated risk. So the KPIs might suggest something is within normal tolerance, but the risk owner might say, that's not right. It's actually riskier than that. It's very rare the other way around. So it is a mix of model-driven stuff and qualitative stuff. And, and I think that has to be the case. I think if anybody says they have a completely model-driven, algorithmic approach to managing risk, certainly in the context of an investment management company, that is probably a kind of a false level of accuracy or belief in models. Now, that is even true in situations where, that are particularly susceptible to modeling. So for instance, in terms of like portfolios, where we have a kind of giant program to manage portfolio risk at the portfolio level, and there are many, many portfolios, even where we have models that like forecast volatility or downside risk, and you put tolerances around that and you say, hey, look, this portfolio, the measured risk should lie within this band. Even where that doesn't, we have a process for reviewing it qualitatively to see whether we think the model is describing risk in an appropriate way at that point of time. So a lot of subjectivity involved. Now, there are some exceptions, and I'll give you a couple of examples where we use kind of actually a model to do something. So one of the things that BlackRock does is it lends stock to the market. So you have a portfolio, and there are many market participants who want to borrow stock, typically to short the stock. And so we lend stock, and at any point in time, we might have hundreds of billions of dollars lent to the market. Now, that is a risk that the client bears. We've lent the stock to the market on the client's behalf, so that's not actually a risk of BlackRock. But then we indemnify the client against loss. So now that becomes a direct balance sheet exposure of BlackRock. So then basically we say, okay, so we're going to take collateral. And so we take collateral on board against the risk of loss. And that's the basic setup. We lend the stock, we take collateral, we indemnify. So then the question is, how much collateral do you need? So that is a stochastic simulation problem where we have a large-scale model of counterparty risk and market risk, and we combine the two, and we take, for instance, correlation parameters based off credit spreads today, and then we simulate the risk of loss, the joint distribution of loss across all these counterparties, and that basically then defines counterparty requirements. That is entirely algorithmic. And it's algorithmic because given the frequency, so this is a daily process, and given the scale of the complexity, there's nowhere really you can have qualitative intervention. So it has to be algorithmic because of the scale and the speed and the frequency. So where necessary, we do use models to manage risk. But more generally, I think we have this blend of the qualitative and the quantitative. I could give you other examples. Some of the other kind of pure model stuff is in the regulatory space, where not in the US, but in a number of jurisdictions around the world, there are capital adequacy requirements that exist for asset managers. And so when we calculate capital adequacy, roughly speaking, we have a model set up where we take the risk dimensions that I was describing earlier, and then we build loss distributions for each of those. We put a correlation matrix across the top, and then we simulate the joint loss distribution, and that defines the capital requirement in some jurisdiction. So that's another model-driven approach. That then becomes a discussion with the regulator case by case. So there's a lot of modeling going on, but sort of philosophically, there's this kind of understanding that models have their limits, if that makes sense.
So if I can just circle back and summarize a little bit, it sounds like you have a mix of qualitative and quantitative, which is typical. You have more of your quantification on the financial risk side, and some of your deep modeling on the capital management side, dealing with regulatory rating agency capital.
Yeah, that's very fair.
And one of the comments you made I really like, I want to circle back to, is you talked about false precision. So we know this, so it's important to focus on. I like to say that, and I do work with clients on, and we teach in our main methodology here is value-based ERM as the core. It talks about how you actually can quantify all types of risk, operational, strategic, financial, to get an overall view of volatility around the organization. And what I like about what you said is that don't assume you have high precision, and make sure you communicate that. So what I always tell my clients is, you need to treat the numbers with the level of disrespect that they deserve. Don't overinvest it. We're predicting the future. You don't have a lot of significant digits on that estimate, nor do you need it, because it can help you parse out in a surprising way sometimes, wow, that strategic risk, that operational risk, this is way more important than this credit risk or whatever. So it can help you prioritize. The relativities are important to understand with that. Of course, change in that's second order, that's higher order magnitude of accuracy when you have deltas on that. That's information you use, but don't get lost and assume you have accuracy. You can't get it, don't need it to inform decision making. And it sounds like that's one of the focuses you have about how you look at it.
That's perfectly said from my perspective. Yeah, I think that it's easy to fall in love with models, and you learn all this maths and you learn all this cool stuff, and it is cool, but you've got to remember, this is the future, and the world is complicated, and you don't actually know what's going to happen.
A second thing I really liked what you said, I hope everybody heard it, was trusting your expertise and overriding models when experts tell you this is wrong. And there's an article I mentioned in the class I teach. There was a cover story article called How Model Risk Devastated an Organization. It's a longer story we don't have time for now, but it's a guy I was talking to, this interesting story, how he was one of those waving his hands in an organization that overtrusted their model. And he had a lot of experience. expertise, and they said, sit down, be quiet, go back to your desk, because we have this multi-million-dollar model telling us it's fine. And
Right.
people, like, if you have expertise, trust it, that gut level feel, listen to it. So that ruined an organization. It's not AIG I mentioned. It was another global organization that failed, was bailed out by their government, not the United States. So it's a story for another time. If we can get into a little bit about, because I think it's a good lead in, you got the qualitative assessment to identify, focus, and calibrate, and then you quantify, or you use a mix of qualitative and quantitative KPIs, KRIs. Then what types of decisions? So can you just give us an overview of the kinds of decisions that are actually informed with ERM information at BlackRock?
Sure. So the information I've described is disseminated through a number of kind of avenues. So broadly speaking, the risk governance structure at BlackRock involves a subcommittee of the board risk committee, and then an enterprise risk committee, which is the executive risk committee of the firm. So I chair that latter committee, and the former committee is, as I say, a subset of the board. And so on a regular cycle, the information we've just described is presented and discussed at both the board risk committee and at the enterprise risk committee. And I suppose the kind of first thing to say is that really what that is about is both the board and senior management reassuring themselves that where there is elevated risk, the appropriate amount of focus and resource is being applied. Where there is elevated risk, there is an appropriate understanding of how long that risk will be elevated for. So, if you've got risks that are outside of tolerance, really the first question is, okay, how long will we be there? And if the answer is, we don't know, that poses a series of questions. So the first use of it is governance and, resource allocation, management focus, et cetera, et cetera. And that's a really important part of the process. But the second thing I would say, and this in a sense is slightly avoiding your question, but I mean it in a very serious way. There is a sense in risk management in that what you kind of hope is that nothing happens. And what you hope is that you have systems and processes in place that mean you're never in a crisis. You're never in a kind of situation where a massive amount of retooling and reorientation and change and resourcing is necessary to fix a problem that has arisen. Because there is a real sense in which risk management is about trying to set up an enterprise and set up a set of portfolios in a way that outcomes are consistent with your risk tolerances. And so we have this kind of mantra in BlackRock, which runs, you can't cram for a crisis, which obviously as students will kind of like resonate. And the idea is you just can't cram for something that is kind of like happening in real time. You have to have figured it out already. And so a lot of the risk management program is about doing that. It's about identifying situations where we need to do different stuff and more stuff now to kind of head off things happening in the future. So I don't know if that makes sense, but that's very much a kind of way that we think about it. We're trying to not be in crisis situations, and the kind of market conditions in particular that can cause issues for asset managers. You kind of see them aperiodically through time, and what you're trying to do is make sure that when you're in the middle of a global financial crisis or a pandemic or whatever, you are set up in such a way that you're not in the middle of a crisis yourself.
I think it's so well said. Two examples come to mind. One was a few months after the pandemic. We gave a talk here, myself and Basil Rabinowitz, who's here, who's passed since. He was Chief Risk Officer functioning of Assurant. And we were talking about the pandemic. He had been in charge of pandemic risk and when he was insurance. And I was talking about looking back at clients that I've had, insurance clients specifically. They look more at pandemic than others because they have 3 levels of impact. There's the investments, the people, but also their insurance coverage. And one of my clients 3 months in said, this is horrible. He goes, but we're actually pretty much, some things are a little different, but what we prepared for in our credible worst case scenario, we thought it through, and it's pretty much on point. So we're actually in good shape to deal with it. Another example was the Maui wildfires. So when I heard it's a great quote, can't cram for a crisis. I love this. But I remember hearing one of the government officials come on the interview and say, well, of course, this was fueled by the hurricane winds, but we know how to deal with hurricanes. We know that. We know how to deal with wildfires. We didn't really prepare for how the combination. And all of us were thinking, oh my gosh, well, you don't have enterprise risk management, because that's what it's about. Understanding individual risk and the combination, because those can be the most devastating. They were not prepared, in my opinion. I don't know what they had in there, but it looked to me like they don't have enterprise risk management. There are many government, they're a little bit behind the market, but they're moving in that direction.
Yeah, no, it's interesting you say that. I honestly think that so much of risk management, not all, but a lot of it, is about that correlation. And so much of it is about, you have kind of loss distributions, risk distributions. And honestly, when you look at it, nothing looks scary if it's all diversified. And when you look at kind of risk events that have actually really hurt entities, normally, not always, but normally, they are due to a misunderstanding of the correlation between loss distributions, risk events. And one of the greatest kind of like traps you can fall into, and you all know this, but we live it every day. One of the greatest traps you can fall into is kind of assuming that there is only one correlation structure. And you can estimate that empirically, you can make it up, et cetera, et cetera. But the reality is there are many different states of the world that might exist. And in those different states of the world, the relationship between risk events can be very, very different. And so a lot of the time, what you're trying to do is identify states of the world in which, two things are true. Firstly, that state of the world might happen. So there has to be some plausibility conditions. But then secondly, a state of the world in which the correlation structure is such that the outcome is particularly adverse for either a firm or a portfolio, or maybe both. And so that kind of concept of conditional correlation or state-dependent correlation is, again, a really big deal. And it's something you kind of learn the hard way sometimes, but nonetheless becomes an important part of your risk management.
I'm glad you said that, because it's something that we teach, and I think it's something that too many financial firms still are relying on because they have that infrastructure. You kind of maybe don't want to give it up, but the multidimensional correlation covariance matrices that assume that this risk function is correlated with that in a certain way, near and around the mean maybe, but we know through the financial crisis that when you're in the extremes, detail, it doesn't work like that. Working through it deterministically, think, as you said, from the source, what is the state of the world? What's the economic scenario, for example? Then how are these things shifting, and looking at it that way? So that's a great. The other thing I love that you mentioned was when we asked the general question of what decisions are informed, is resource allocation. Because if it's not happening, then there's not really an effective ERM program. Because we talk about this a lot here, that the main point is when ERM came along, if it's done right, you have a limited amount of time, attention, and resources, and being able to understand we are over-focused on that, and we need to take people away from that and move it over here, or money, or systems. That's the best we can do. Things can still happen, but we're going to take better bets, and over the long run, we'll be better off.
Right, and I think, so I agree completely. And one of the kind of, some of the power of ERM is that it's one of the few places where you look at the firm kind of holistically in a completely cross-sectional way. And so, inevitably, and for kind of good reasons, firms tend to be compartmentalized because you have different bits of business going on, you have specialization, and so most resources are allocated to specific sets of tasks. They have particular objectives, often commercial objectives. And someone's got to kind of sit back and say, but is all this stuff together making sense vis-a-vis the risks we're taking and the returns we expect? And so that kind of, transverse look at a complex organization is critical. And looking at it through the ERM lens is also, I think, critical.
Thank you. Can you share, I was gonna ask about risk appetite. You covered a little bit. Can you get a little bit more into how you define risk appetite? Is there a concrete way that you do that?
So in the context of investment, it is difficult, but it is fairly algorithmic in that there are objectives, there are knowable relationships between risk and return, and obviously that's complicated, you can suffer from false precision, but nonetheless, some relationship between the risk you take and the return you expect. And so you can kind of calibrate risk taking in the investment space, reasonably quantitatively. And we have a program that spans really the entire platform that does that. And that's just a lot of compute and a lot of kind of like quantitative stuff. In the enterprise space, I think one is harder because it is necessarily more subjective. And so, if you ask the question, how much what is my tolerance for people risk or for, technology risk and so on and so forth. These are kind of elusive things to quantify. But nonetheless, you can say something. So for instance, if you are a dynamic organization, a growth organization, an organization that wants to do new things, it may be that your tolerance for change risk is higher than your tolerance for risk in the context of financial crime. So you might say we have zero tolerance for risk in one dimension, and we have medium tolerance in another, which actually then gets you into an interesting dimension where in some cases you might not be taking enough risk. So if you look back and you have medium tolerance, but actually over the last 5 years, you've never been taking any risk, it begs some interesting questions about strategy. And so those things kind of can arise where in some situations you ask yourself the question, are we really taking enough risk in this context? But in the enterprise space, you do kind of think about tolerances. It tends to be a subjective discussion at the level of a board or an enterprise risk committee, an executive committee. I think it does add value. I think it is a useful exercise, but it is not straightforward.
Challenging, yeah. There's a lot of disagreement among ERM experts around the world, but the one thing they all agree on is there's not many great, clear, quantitative risk appetite statements out there. So, but I'm glad you also mentioned that you need to think about the enterprise level and also specific. It really needs to get down to the specific risks and scenarios and look at your comfort. I also like that you talked about, can we take more risk? I had 2 clients that said, we want to take more risk, but we don't know how much more, and we don't know how to prove that comfort to our key stakeholders. Can you help us? An ERM program that can do that is a real ERM program. Because people give lip service of, ERM should not just be downside, but most people don't know how to operationalize that. They don't know how to design a methodology that actually can do that, to look at risk reward agnostically and just look at overall volatility and be able to inform, let's take more risk comfortably and prove it. And that's a powerful thing.
Right, and it can be cultural. It can be about the ways in which you take decisions. It can be about the people you have taking the decisions. And so, where you think you're taking not enough risk, it's about, do we have the right culture? Do we have the right people? Do we have, the right objectives and so on and so forth? But it's definitely a two-way thing, right? It's
I want to jump to, if you could just, whatever you could share about some of the successes of the ERM program at BlackRock.
Well, as I say, in some sense, you can't cram for a crisis. So, we would say that, one metric of success is that, when we look back at the firm over like a number of years, we've not encountered or not experienced, a series of big risk events, which would imply that somehow the risk management is not working in the way it should. And so to some extent, that's my kind of like overarching metric of success in both the enterprise and the investment space. If you don't have blow-ups, if you're not kind of, encountering difficulties which were predictable and avoidable in some probabilistic sense, if that is not happening, then in some ways that's a good risk management program. We have this other joke that you could be a risk manager in the context of nuclear power plant, safety, and you could spend your entire career inspecting nuclear power plants, ensuring they're kind of safe. And the measure of success would be nothing happened over my entire career. And that's not the business we're in, because we are actually in the business of taking risk. But nonetheless, there's some kind of sense in which, you can see that like one metric of success is nothing really bad happened. And obviously we hope that continues. I think though that said, that we can point to, like various situations where, the firm had ideas, and typically we're not in the business of stopping things, we're in the business of modifying them. And, there are countless examples where, the firm's intentions, investment intentions were kind of modified by risk management in, for instance, the product space, where we have this kind of continuous product generation. What you're trying to do there is kind of, foresee situations, often in the space, for instance, of liquidity. And you're kind of trying to modify product design so that, if you get into certain states of the world, you don't have, problems. And so, I was in a discussion yesterday about some balance sheet exposure, some assets, some clients, which is kind of normal stuff. That's what we do. And it's all about what could happen to make this, set up in the wrong way. And it's about thinking about risk scenarios. It's about just kind of making sure that the risks we're taking as a firm are kind of calibrated off, one, some downside tolerance, and two, the return on that risk. And so that was, yesterday. And so that's just a continuous process.
So my next question, you might not have much to say about it, because it sounds like you're pretty comfortable where you are now with the ERM program. I was going to ask, what challenges remain ahead? What might you want to enhance going forward in the program?
So don't say that I'm comfortable. I think so clearly this is something that changes all the time. And I think that, the industry in which we operate is a very restless, dynamic industry. And if you compare it to where it was 10 years ago, it's a very different place, 10 years before that, and so on. And I have no doubt that, if we look back in 10 years' time, we'll be in a very different place again. And so, basically this is not a stationary problem. This is not something where you build it and then it's done, because, the world outside keeps changing around you. And so that's the first thing. So I have no doubt that we need to continue to evolve. The next thing I'd say, and this is like a modern cliche, but the way that technology is impacting everything is just stunning. And we are kind of very, very focused on making sure that, changes in available technologies are reflected in what we do. And actually, in the enterprise risk space, I think it's really interesting because, some of the risks that exist in the enterprise space historically have been more resistant to quantitative analysis than, say, risks in the investment space, where we're very familiar. So a lot of the conventional kind of statistics that you would, learn at university are highly applicable in the context of financial risk, in the context of market risk, and so on. And so there's been massive application of all those kind of techniques to financial risk. Enterprise risk is kind of more kind of challenging in the context of like normal sort of linear Gaussian kind of statistics. But where you have, kind of more nonlinear, and I hardly dare say the words, but where you have kind of artificial intelligence, it opens up a whole bunch of interesting possibilities. So for instance, one of the challenges you face as an asset manager is that you make mistakes, you make errors, you trade things the wrong way up, you forget to trade, you trade the wrong amount or whatever. And every asset manager in the world makes these kind of mistakes all the time because you're doing a vast number of trades, the vast majority of which are accurate, but there's some residual that is an error, and that is an enterprise exposure of the firm. So we compensate clients when those errors occur. Now that is quite resistant to modeling. But on the other hand, you think, well, we have large data sets of the errors that we make, and then attributes of different mandates. So these would be different clients, different portfolios, and things like where the client is, how the client communicates is really important, frequency of communication, a type of strategy, so on and so forth. That is actually very amenable to like different types of modeling. So kind of we think that going forwards, some of this new technology absolutely kind of comes into the enterprise risk space in a way that perhaps historically it hasn't. So, the world changes, technology changes. And so I think those two things coming together will mean that in a few years' time, our enterprise risk program looks different than the way it looks today.
Thank you. We're almost at Q&A time. I just want to pose one question, if I could, before we go to the audience for questions, and that is, what advice do you have to our students and graduates?
Sure. So look, people, often ask me, what do I need to succeed in the kind of risk management space? And I kind of always say three things, basically. Firstly, you do need some technical skills. You need to know stuff. And, I think that's kind of two different levels. You need to know some technical stuff about risk management. You also be able to kind of you need to be able to sit back and kind of see things at a broad level, see the big picture. I think it's very easy to get caught up in detail, especially if you're that kind of person. And a lot of people interested in risk are that kind of person. But I think actually seeing, an enterprise, seeing that it's a kind of commercial organism and understanding that is an important thing. So some technical skills, okay? Secondly, I do think that, especially at more senior levels and to be impactful, communication is a kind of really, really key skill. And the ability to kind of explain things, the ability to slow it down and, help colleagues understand what's going on is really key. So communication is definitely a kind of skill worth practicing. So some technical skills, communication, but then lastly, you've got to be interested. Okay, so I do have this idea that there's quite a lot of people who know a lot of stuff and are very good communicators, but they're not really interested in risk management. And that's good. Do something else. So those are the three things: communication, technical skills, and it's got to be interesting.
Excellent. So we're out of time. I just want to summarize some of the themes that I thought I heard, and please correct me if I'm misquoting here. One is the importance of socializing your ERM program. I actually have 10. Usually I only have a few here. It's a very robust discussion, so thank you very much. Second, you have to have fluidity. You have to constantly update and have that network and connection to update your information, not periodic updates only. Three, it should be about resource allocation. You should take the information should be actionable. You should be shifting your time, attention, and resources. Fourth, which is probably the quote we'll all be using for quite some time, is you can't cram for a crisis. I think really well said.
So I have to tell you,
and a little alliterative too.
I have to give that proper attribution if you like it. Okay. So I am BlackRock's second CRO. That quote comes from BlackRock's first CRO, Ben Golub. So
we had Ben on a panel
so
a few years ago.
That is his quote.
So, but he didn't mention it then, so thank you for bringing it to us. And the attribution. 5 is the big impacts are often caused, as we know, by misunderstanding of correlation between multiple risk events. 5, if I've got this right here, I heard a couple times, ERM is harder than RM. ERM is harder than risk management. You've mentioned it a couple of times, so that's something we definitely appreciate.
Through one lens, yeah.
6, ERM should be about modifying what we do, not stopping what we do. It's being able to do more with it. 7, and I'm very glad you mentioned this, communication. Ben mentioned that as well. He said we'll never hire anybody without outstanding communication skills, and I'm assuming you're the same. We do have one of our 5 core courses is strategic communications for risk professionals, so we emphasize that. Another point is buy-in, the importance which is related to communication. You got to get buy-in. You got to get people to go. Just having the best methodology is not going to help you. You've got to get people. The only way to do anything of value is with and through other people. You've got to get people to come with you and to show the benefits of it or the threats to them, as you mentioned, with visualization of deterministic scenarios. And the one I would like to close with is, which I think we all agree with you, is the ERM is super cool. So thank you very much, and please join me in thanking Eric for a fantastic conversation.
Thank you very much.
Thank you so much.